Hey everyone, this video we're going to talk about engulfings. Now, engulfings are one of my favorite candlestick patterns. In this video, you're going to learn exactly how to trade candlestick engulfings like a pro. It doesn't matter if you are a professional or a beginner, it doesn't really matter because engulfings are by far the most reliable candlestick patterns amongst all. When I first started trading, I started to get into those, retail, not retail, just basic stuff like candlestick stuff, like chart patterns. And engulfing would always be something that I always saw. It was like the first at the top of the list. And even after many years, I have to tell you this: engulfings is still something that I trade. They used to be dojis, they used to be morning stars, but those are not that significant anymore. So you can say that they're somehow more inferior. But today we're going to focus mainly on engulfing. Now let's start. Before we get into the advanced stuff, we first have to understand the very fundamental concept. What are engulfings? So let's just draw engulfings. What are the qualifications for a bullish engulfing? So you have a candle here, and then you have a bigger candle, let's say here, and this candle is green. This becomes the bullish candle. And the engulfing has only one rule: this candle has to be bigger than the previous candle. Okay, and the rule is that when it's bigger, it has to be the body. It can't be something like a wick. For example, if it's a wick bigger than the previous candle, then it would not be considered an engulfing because the body is not bigger than the previous candle. The wick does not count. The body has to count. So now that you understand that, let's look at the bearish side of engulfings. It's pretty much the same thing. There we go. This is the bearish engulfing candle. As usual, we cannot have it as a wick. A wick bigger than the previous candle is not considered an engulfing. It has to be a big, strong candle that opposes the previous candle. And yes, it has to be the body, it cannot be the wick. Okay? So we have to also imagine every single candlestick you see on a chart like a battle between buyers and sellers. So let's say you are on the 4 hour. Okay, so during that 4 hour candle, during that 1 4 hour candle, buyers and sellers were fighting. And if buyers won, you would see a green candle. Whereas if sellers won, you would see a red candle. Now, this is a very simple fundamental concept. However, when you see a big green candle, a big white candle, in my chart it's blue, but it's basically the same thing, referring to your chart: an up candle and a down candle. However, there are times where big greens and big red candle appear, and that is when what we call engulfings. They are special. They are recognized as a pattern because these are very powerful, potent, and often an early indicator of some sort of reversal. Now, I cannot guarantee you that it's going to be a big reversal. It's going to be a long-term reversal, but it would be at least you can expect a short-term reversal. Now, to this, there's still going to be fake outs, fake engulfings. We're going to discuss it in this video as well. But let's start with how we can find them and how we can use context. I don't want people to think, oh yeah, it's a pattern. I want people to understand that engulfings appear for a reason. Okay, so this is a very good example. First, you see a channel. Usually, when we want to use engulfings, I would recommend using channels, wedges, anything like that, anything like a pattern that you can have, and some sort of pattern, some sort of line that you can draw. That is just to help your visualization. Now, once you can visualize the pattern, you don't need the lines anymore. Okay. The main thing I want you to understand is this type of engulfing works best in a trending or range. Sorry, this type of engulfing works best in a ranging market. Trending, not so much, but you can still use it very effectively. But the best type of market engulfings can be used in are ranging markets. So here is an example of a ranging market. We're ranging upwards. Okay, so we're still in this channel. So let's see where's the first engulfing we can see. So first, we saw an engulfing here. Okay, so once we saw the engulfing, the price slowly goes up and takes out the previous high. Now, theoretically, if we were to only use engulfings, which is not a wise decision, usually when you're using engulfing candle, you have to incorporate other strategies. For example, in our previous video, we learned about SMC, we learned about RSI, we learned about a lot of stuff. And so you can add all those stuff, stack them together, and trade. Engulfing candle acts like a confirmation. It is not a good idea to use them as some sort of trade indication. So this could be your trade setup. Once you saw the engulfing, you could wait for a small retracement, and then you can enter, and then you would target exactly at the liquidity point. Now I know some people, they tend to have very, very crazy take profits. They put it all the way up, and this is not wise, because a lot of people think that the price is going to go in their favor all the time, and sometimes it does. But you can't take them for granted. You can't let them go all the way up, because it's not going to happen. So don't think the price is going to shoot all the way up. Like most people have a 1 to 10 risk reward ratio. And when you have very high risk reward ratio like this, it's time to question whether your strategy is actually working. Because only a few people in this world can actually make profitable consistently while using these type of very crazy risk reward ratios. So here's another example where we can see an engulfing appear. So this candle here has an engulfing. We see this candle right here, this blue candle, okay, engulfing. So once we saw the engulfing, we saw an immediate push all the way back up. So similar strategy, we could use the very similar trend way where we can enter exactly after the engulfing closes, or you can wait for a retracement, and you would target exactly at some sort of liquidity point, as you can see. And so yeah, you might say, oh well, I didn't take the full take profit. I should have targeted higher. But you can't see how high the market can go, can you? You can only, kind of predict. So at the riskiest line you can, because that's the riskiest way. Okay. So another example where an engulfing did not appear and there was a sign of weakness was here. First, you saw a white candle, which is what we call a down candle. Okay, you can see clearly this candle right here. And then this blue candle appeared. Now this blue candle did not engulf. It's clear to me that it did not engulf because it did not go over the previous candle. So it did not happen. So we were not looking for long. We're not looking for long. A lot of people are longing this asset right here, even though it shouldn't be longed, because there are no engulfings. There are no engulfings because engulfings mean really strong buying power. You can call it buying power, you can call it bullish, whatever you want to call it. But the market dynamics is a bit more complex than that. But we can just kind of simplify it into very simple words such as buying power. Although some might argue that buying powers are pseudo and they don't exist because the market moves in a way the algorithm controls, and there are no such thing as buying powers and selling powers, and that could be true. So, whatever you want to call it, as long as you understand that there are no engulfings here, you do not want to look for longs. And of course, some people look for long and they made a mistake. And obviously, they get stopped out very simply. Okay. So, in the same sense, we could see a bearish engulfing. So, easily, I can immediately spot a engulfing. When you see engulfings appearing multiple times, when you see engulfings appearing multiple times in a singular type small area, that is a very strong sign that the market wants to go lower. So you would notice less bullish engulfings. So here you can see a small bullish engulfing where we did have a short-term rally, but compare that to a lot of bearish engulfings that we can see. This tells us that we could see a small rally upwards and then continue a big move down. So did we have it? Yes, we did have a small bull engulfing that led to a market push, but then really quickly we started to see a lot of engulfings, a lot of engulfings, a lot of engulfings. And these are usually very strong signs of bearishness. In the same sense, when we're in a bullish market, we rarely saw bearish engulfings. Instead, we saw a lot of bullish engulfing, bullish, a lot of bullish engulfing, and this one was even a bearish engulfing. So until then, you can actually go to different time frames to find similar structures or candlestick. So for example, if we go to the daily, we can see the engulfings are clear, engulfing, engulfing. And for bearish, we didn't have much engulfings on the daily. Instead, we could actually see the engulfing candles on the lower time frame. So you want to look at the time frames dynamically. The next thing you saw is a big engulfing here, a big engulfing here. When you start to see very big engulfing candles like that, it signifies a trend to lower, not trend, maybe a indicator to go lower. And we did have what we expected in engulfing. So this is how engulfings work. Eventually, though, we started to see some sort of retracement where we started to see less engulfing and more bullish engulfing. So we started to see a bit more bullish engulfings, bullish engulfings. You can see it here. So we were anticipating some sort of upside. Now we don't know when, but that is a signal of accumulation for the upside. So this is something that we understand. So now let's look at the potential sides of fake engulfings. So let's say that you are in a uptrend. In previous video, we learned about structures, and the structure here is bullish because we shifted the market structure. The market has broken the previous swing high, and it has turned into a bullish market sentiment. Now, keep in mind, we're on a daily time frame. A market structure break on a daily time frame is a very powerful indicator that the price is really likely to go higher. Now, once we understand that the market is now shifting to bullish, we now understand that there is some sort of engulfings that we want to avoid trading, and that is the bearish engulfing. When we are in an uptrend, there is no reason to trade bearish engulfings. A good example is a bearish engulfing here. Now, if you go to the low time frame, I'm sure you can find some sort of engulfing, but this is exactly when you don't want to trade it because we broke structure. That is not the time to look for shorts. Another better example, let's go to the 4 hour so we can see things in detail. Because engulfings can be used in lower time frames. If you're using the 15-minute, 10-minute, it works as well. It doesn't matter what time frame you're using, but that's the general rule. It is that the higher the time frame, the more reliable the indicator is. Indicator as in engulfing, not the indicator you use. So please don't get messed up when I say indicator. Okay, so engulfings, you can see engulfings. Um, you can see engulfings. Now, this engulfing actually signaled a short-term rally downwards, but then a continuation higher. And then here's the tricky part. You can see a lot of engulfings, and we're going up, right? Engulfing big candles, big green candles. And then all of a sudden, we have a big white candle. So that was a signal that the market wants to go down. But this is only one candle. We can't decide too much from one candle itself. So we wait for a while, and then we see another engulfing, another engulfing, another engulfing. So by this time, you should be having a bearish market sentiment. But I'm not saying that you should short and put your position like this unless you're a swing trader, but this is still going to be a very terrible idea where you're going to say, oh, I'm going to target all the way down, like something like that. No, that's not how it works. When you are trading on the 4 hour and you have a bearish market sentiment, you should be dropping out to time frames like the 15-minute, the 5 minute, and you want to be looking for smart money concepts or indicators or some sort of indicator that the market wants to go lower. So clearly here, if you are using simple market structure, you could see that the market is building up liquidity to the downside. Now, I'm only drawing up this trend line for you to visualize it better. Do not think that the trend line exists. The trend line simply does not exist. It's a pseudo, it's an illusion the mind creates. It's a way that the mind creates a pattern, but the market does not move in patterns. It does not move in trend lines. The trend line exists because our mind somehow connects them. So if you use a smart money concept perspective, we have an order block, and then we have a liquidity build up, and then you have a bearish engulfing. So once you incorporate everything, this is a sign of bearish. Now, a way to enter this, now this is not real life chart, this is past chart. So let's say I were to enter it at the break of the order block. So where would I put my stop loss? I would put it right above the stop order block. Now, where would I target? Well, there are many places we can target, but when we are looking for take profits and stop loss, please do not make the mistake of simply going to one time frame. For example, if I'm trading on a 15-minute, and then when I take my profit and stop loss, I only look at the 15-minute chart. That is a huge mistake. You should be going through all the time frames if you can, or go through the major time frames such as the 15-minute, the 1 hour, the 4 hour, the daily, and the weekly. The monthly is for the overall market sentiment, whereas the weekly is for the weekly bias, and the daily is very important. So in this example, this candle acts as a point of liquidity, and this acts as a stop loss, and this would be my entry. A 1 to 4 is actually a very good trade, but in reality, trading is not that perfect. Sometimes we might have very bad entries. Regardless, 1 to 3, 1 to 2 is beautiful. This trade would have worked very well. In the same sense, we saw a bullish engulfing. Okay, we saw another bullish engulfing. This candle, can you see it? But this candle was not convincing. It was fairly small, even though it is a bullish engulfing. So we waited for the next candle and we saw another bullish engulfing. Now remember earlier we said that the market is in a bullish sentiment. Bullish sentiment. Yes, we did have a short-term rally downside, but we did have a bullish sentiment, the overall market sentiment. So now that we understand the market, is bullish overall, and we're seeing bullish engulfings forming, now we can start to take our longs. And for example, if you were to close it at this level, you could put a stop loss right below the bullish engulfing, because if the next candle goes below this bullish engulfing candles, it means that a new bearish engulfing has appeared, and that is a sign of bearishness, which you do not want to be in a trade anymore. So using the same logic, you can target exactly at liquidity points, exactly areas like this, like this, like this. Let me say, oh wow, 1 to 3 is not attractive. 1 to 3 is very attractive, just so you know. I know some trading industries, they like to promote 1 to 10, 1 to 20, but that's not realistic. The only way you can do that is through very tight stop losses, which is same thing as 1 to 10, because you're going to get stopped out many times and you're going to pay commission for every time, and it's going to stress you out more. So you have to think about the type of trade you want. Okay, so this is it for this video. I hope you like this video. If you can comment in the comment section, and if you do find this video useful, you can consider liking and subscribing to this channel. I upload 1 to 2 times a week, so you can get informed, and new content, uploads every now and then, every week at least, at the very least minimum. I promise you I will upload it every week or twice a week. If you think that there's a better way for me to teach these concepts, maybe I'm simplifying too much or something like that, just let me know in the comments so I can help everyone out in this channel. Let's grow this channel together, and thank you for watching. I hope to see you in the next video.